Welcome to Explain the Charts, where we break down the data to help you understand the market's next move. Today is Monday, March 23rd, 2026, and Ethereum is currently navigating a high-stakes balancing act between technical pressure and institutional adoption. The current global climate is heavily influenced by geopolitical tensions in the Middle East, specifically following an ultimatum regarding Iran that has pushed crypto assets into a defensive posture. On the fundamental side, we are seeing the rollout of the Fusaka upgrade while looking forward to the Glamsterdam and Hagota milestones later this year. Despite these technical improvements, the market is reeling from over $98 million in liquidations following a hawkish Federal Reserve stance and a rising inflation outlook for 2026. We have also seen spot Ethereum ETFs recording significant net outflows, indicating a momentary cooling of institutional demand. However, some analysts like Tom Lee suggest that Ethereum is flashing bottom signals near the $2,150 level, even as Vitalik but Aaron continues some periodic liquidations. The unlocking of ETF options trading is another major tailwind that could provide the liquidity needed for a massive trend reversal. Currently, ETH is trading significantly below its 200-day simple moving average of $3,171, which defines the long-term bearish context we are in. Let's look at the charts to see how these news events correlate with the actual price movement we are seeing today. Starting with the daily chart, we can see the massive volatility Ethereum has endured over the past year. The peak back in August 2025 saw ETH reach heights near $4,958 before entering a long-term cooling phase. Throughout early 2026, the price has struggled to maintain footing above the $3,000 level, leading to the current range-bound behavior. Notice the sharp decline in February 2026, where the price dropped from $3,300 down into the $2,000 zone in just a few weeks. This coincided with trade war fears and concerns regarding AI-driven disruption in the tech sector. Recently, in mid-March, we saw a relief rally attempt that reclaimed $2,300, but it was short-lived as sell pressure intensified. The daily candles show a cluster of resistance between $2,150 and $2,400, which has become a major overhead supply zone for whales. If we look at the volume profile, the sessions with the highest activity have occurred during these breakdown points, suggesting aggressive distribution. However, the support at $2,010 has held multiple tests, forming what some call a stealth accumulation zone. The daily RSI is currently hovering in oversold territory, which often precedes a relief bounce if macro conditions stabilize. We are also watching the gap between the 20-day and 50-day moving averages as they begin to converge. A crossover here could signal a shift in momentum, but for now, the bears remain in control of the daily time frame. Switching over to the 1-hour chart, we can get a clearer view of the price action during this month of March. Early in the month, Ethereum attempted a breakout toward $2,200, but was met with heavy selling on March 4th. We can see a series of lower highs forming on this time frame, which is a classic bearish signal. On March 13th, there was a brief spike to $2,211, likely driven by renewed retail interest and the BlackRock ETF news. But just as quickly as the price rose, it retreated back into the $2,000 support range by March 15th. The hourly data highlights how sensitive ETH has been to the headlines coming out of Washington and the Middle East. Every time there is an escalation in the US-Iran situation, we see a corresponding high-volume red candle on this chart. The leverage ratio on exchanges like Binance has reached a record high of 0.75, which means small moves can trigger large liquidation cascades. This high leverage is visible in the long wicks we see on these hourly candles, indicating frequent stop hunts in both directions. Current consolidation is happening right around the $2,050 to $2,080 range, showing a temporary lack of conviction from both sides. The SMA 20 on this time frame is currently acting as immediate overhead resistance. Until we see a close above $2,128 on the hourly, the path of least resistance remains sideways or downward. Wait for a high-volume breakout from this consolidation box to confirm the next short-term trend. Now, let's zoom in even further to the 15-minute chart to look at the specific reaction to the March 18th news events. On March 18th, Ethereum was trading steadily near $2,331 before a sudden drop began at 10:29 Universal Time Coordinated. In less than 2 hours, the price plummeted from $2,331 to below $2,240, marking a severe intraday correction. This move was likely triggered by the combination of the Trump ultimatum and the Fed's hawkish decision. The volume during this 15-minute window spiked to over 8,500 ETH per candle, showing intense panic selling. Following the initial crash, the price found temporary stability around $2,180, where a whale investor reportedly scooped up $111 million in ETH. You can see the V-shaped recovery attempts that failed to reclaim the previous highs, turning old support into new resistance. This chart shows how fragile the current market structure is. The setup is described by many as fragile due to the geopolitical weight. Notice the fast confirmation rule. Testing period mentioned in the news doesn't seem to have offset the macro sell-off yet. Technically, the 15-minute chart shows a descending triangle pattern that broke to the downside on March 19th. We are seeing a series of very small candles now, which suggests the market is waiting for the next catalyst. The low gas fees on the network, reaching near zero levels, haven't been enough to entice fresh buyers in this fearful environment. Traders should watch the $2,070 level on this chart, as it has acted as a pivot point for the last 24 hours. A break below the recent low of $2,025 would likely open the doors to a test of the $1,900 zone. Short-term scalp opportunities exist between the $2,050 support and $2,090 resistance levels. Going back to the 1-hour view, we can see the broader consolidation pattern that has emerged since that March 18th drop. We are currently range trading between $2,025 and $2,127, which are our local boundaries for this week. The triple witching options expiry events mentioned in the news are clearly causing this choppy, non-directional price action. Institutional flows are modest, with only $155 million flowing into crypto ETFs recently, which isn't enough to drive a major rally. If the price can break above the $2,128 level, we would look for a move toward the major supply zone at $2,350. However, the probability of an upward breakout is currently estimated at less than 20% due to weak buyer momentum. The high leverage ratio on Binance remains a caution signal for anyone entering new long positions here. Whale profitability is currently high, which can be a dangerous signal as it provides an incentive for them to take profits. On the other hand, the Ethereum Foundation's move to stake 70,000 ETH shows long-term confidence in the network's yield strategies. We must also consider the Citigroup report, which lowered price targets to $3,175 due to regulatory delays. This suggests that the moon targets of $10,000 might be pushed further into 2027 or 2028. The technical setup suggests that sideways consolidation is the most likely scenario for the next few days. Watch for any divergence in the RSI on this hourly chart, as it could signal an exhausted trend. If we see the RSI making higher lows while price makes lower lows, that would be a bullish divergence to trade. For now, keep your position sizes small and wait for a clear trend confirmation. To wrap things up, let's look back at the daily chart and summarize our key price levels and predictions. The most important resistance levels to clear are $2,128, $2,150, and the major overhead zone at $2,350. On the downside, we must hold the $2,010 support. Failing this could lead to a deeper slump toward $1,500. Our unbiased prediction is that Ethereum will continue to consolidate between $2,000 and $2,150 in the short term. We see a 60% likelihood of this sideways range continuing until we get more clarity on the Middle East conflict. A bullish reversal has a 20% likelihood and would require a de-escalation of war rhetoric and strong ETF inflows. A bearish breakdown also has a 20% likelihood, which would be triggered if the Strait of Hormuz is actually closed. Things to look for in the coming weeks include the PCE inflation data and any updates on the Clarity Act. Smart money appears to be in an accumulation phase, but retail fear is currently at a local peak. Remember to watch the 200-day SMA at $3,171 as the ultimate goal for the bulls to reclaim long-term control. Keep an eye on the exchange outflows, as 31 million ETH withdrawn recently suggests a tightening of supply. This supply squeeze could be the catalyst for a rapid move up once the macro fear subsides. Thank you for watching Explain the Charts, and make sure to subscribe for more in-depth market analysis. Please note that this video is for informational purposes only and does not constitute financial advice. Always perform your own thorough research and consult with a professional before making any investment decisions.